So it was awesome. And,
beautiful.
We like the volatility.
For more than that.
Right. We like the movement, even though now it's kind of died out. But all that matters was the first half hour of the day. How's everything by you, Kelly?
I sent you a Twitter space.
We had a lot of excitement today.
Oh, you sent me a Twitter space. Let me see if I can get. How come I don't see it? Okay, where's my Twitter?
I just sent it. For those of you that are on Twitter Spaces, I'm going to post the YouTube link in a little bit underneath this. Actually, let me do it now.
Okay.
So that you can see the charts and see us talking to you. So you can see our charts, screens.
Oh, sorry. This always happens with me. I have to.
Okay, got it.
Okay.
All right, we're ready to go. It was a big week, Corey. I mean, we had a lot going on.
It sure was. Yep.
A lot of really big events on the calendar. I'm not sure whether we got that much more clarity on what happens next. I think, the central bankers and, the data still leaves everyone somewhat confused. And I think, that's why, at least today, in the markets, in FX in particular, you're seeing quite a bit of volatility, because I think, we did not get the level of clarity that I think, everyone was hoping for. The Federal Reserve, they came out, they raised interest rates. Powell, what would you make of Powell's statement for us?
I think Powell basically wants to stop, but he's not sure, he's quite able to. They clearly, I think, are concerned about breaking the banks. And the problem is it's a self-enforcing. With markets, it's always kind of a self-reinforcing problem, because now you have a whole bunch of shorts who are just mercilessly shorting all these regional banks into bankruptcy. So you have this very, very vicious cycle of toxicity that basically the Fed has to deal with. And there's even talk now, which I think is actually a pretty good idea, and although I know it's very, very anti-free market, to ban shorting of bank stocks. And the reason why I think it's a good idea is because banks are different from every other industry. They're kind of like a utility. And therefore, if you sort of allow this random speculative shorting of banks, you're effectively, it's like saying, we can allow terrorist activity against electricity. It's a service. It's a public utility good that destroys the whole society if they take a lot of these banks out. I mean, TD canceled their Horizon deal with Horizon. Those are all, I think, on the credit side, worrying issues. The underlying economy is doing great, but the financial backbone, which supports that whole economy, is really going through a lot of stress now, and the specs are only adding to the problem. So I do think that's why he's concerned, and he doesn't want to raise rates anymore. On the other hand, jobs were hot, labor was hot. I mean, it's the single greatest joke I think in the market is every single macro person who's calling for the recession for the last decade. I'm going to call everybody who's a macro bear the Robert Prechter of macro. I'll be calling for a bear market until from 3,000 Dow to 35,000 Dow. That's the equivalent of everybody calling for a recession, in my opinion. So that's interesting. But I do think that the thesis Kathy was saying, there are these cross currents that are creating a lot of uncertainty in the market. So yeah.
I think that Boris is absolutely right. I think the Fed wants to stop, but they can't. But Powell also made it very clear that the change in the policy statement, where they removed the language about future policy action, is very, very important. And I think this is the process the central banks go through in order to slow it down, in order to pave the way for a pause or an end to the tightening cycle. First they kind of dropped this language from the statement, and then maybe because.
Hey, Kathy, for our viewers who aren't familiar, can you just share what the language was? Was it something where they're going to be data dependent now?
So
they dropped the explicit language that said that they felt that there was going to be need for further rate hikes. That was the explicit sort of like they dropped the forward guidance on any additional rate hikes. And I think that was a very significant change of tone, which obviously the market reacted to positively initially. Then they, as always, I think what I read is very, very funny. I think like Powell has had like 28 or 29 conferences, and like 28 of them have been a negative equity reaction. It's probably one of the greatest statistical arbitrages you could possibly imagine. But it's just, it doesn't mean anything because the next day markets, jump back up.
Sure.
So,
yeah, to be more specific, the policy statement before, explicitly said the committee anticipates that some additional policy firming may be appropriate. So that's gone. So instead, they just said in determining the extent to which additional policy firming may be appropriate. So that's how it changed. It went from we anticipate to determining whether or not, more may be appropriate. So, like I said, I think that this is the process of transition. And it's a tough one for the central bank because, like, Boris pointed out, the jobs report was extremely hot. And that's really what's keeping inflation high. That's also, what's making the job of the Fed so difficult to halt those rate hikes. Now, what's interesting, though, is that June Fed fund futures, I was just looking at that while we were talking.
Yeah, I saw that earlier today, too. 100% zero.
Yeah, they haven't changed all that much. Still, the market thinks that, the Fed is, for now, the market thinks that they're still going to pause. It's 97% chance. Many of you are wondering, how do we get these probabilities? I think this is a very good time to talk about how do you look this up yourself rather than waiting for someone to tell you what it is. So let me share my screen.
And guys, just so everybody knows, you could ask questions in the comments. We'll be answering questions also, throughout and at the end of the show.
Everybody who's listening to us on Twitter, go to YouTube right now. Like 90% of the show is visual. Okay, so you listening to us on Spaces, hit that YouTube link because Kay is going to share charts. I'm going to share charts. We're going to show our setups. Make sure you're watching us instead of just listening to us.
So I'm going to share my screen. It's quite simple. So you want to figure out what are the probabilities of the market is pricing in for a Fed hike. So all you type in Google is CME FedWatch tool. And then the first one that you see is the link that you click, which is the one that I clicked on. Am I sharing my screen right now?
No, we see it. We see it.
You sure are.
Okay, great. And here it is. Right now, and this kind of changes in real time. 97% chance. There's a lot of different measures, I would say, of the market, how the market is pricing in a Fed rate hike. But this is the most popular. This is the one that a lot of like Bloomberg and them, kind of reference, which is the CME Fed tool. So the market is currently pricing in a 97% chance of no change because the current rate is 5 to 5.25%. So pretty much 97% chance of no change in June and a 2.8% chance of a rate hike. So I think that's really important. But what's also really interesting about this tool is you can fast forward. Let's look at September. We know the current rate is 5 to 5.25. So 5.25 is right over here where I'm pointing. The market is pricing in a 23% chance of rates remaining at 5 and 5.25. They are pricing in, 52 plus 22, so 74% chance, about 75% chance of at least one rate cut by the Fed by September. So this is how you read this, and this is how they come up with what is the market pricing in for rate hikes or rate cuts at the this year, and where are people getting these numbers on the market expecting a rate cut? It is from, this is from the FedWatch tool where the probabilities are based upon the Fed funds contracts.
Right, the Fed funds rates futures, which trade, like to serve to understand also the mechanics of it, they trade 1 minus. So like if it's, it's like if it's 2%, if it's 1 minus 98, it's a 2% chance that, it's not going to happen. Like the price, that's how it trades on the futures. But regardless, I think the interesting thing here is the incredible divergence between what the credit guys are doing. What the credit guys are basically pricing in a recession and the actual economic data, which is showing anything but. And I don't think I've ever seen in my life such an incredible divergence on the macro level between what financial markets are looking at versus what the actual economic data is printing. And, I think I'm as befuddled as everybody else as to why the markets are so convinced. I mean, essentially, this is pricing in kind of an LTCM type of a credit shock. There's under no, if basically things stay the same as they are now, or even get even just tiny bit worse, I don't know, we print 150,000 jobs. There's zero chance that the Fed would be compelled to lower rates, right? The only way I could imagine the Fed lowering rates in September or December is if we have some unbelievably contractionary credit event, like, I don't know, Citibank going bankrupt. I guess Citibank is the most likely candidate. Like Citibank going bankrupt, one of the four major banks, literally on the ropes, literally balance sheet run, all the specs are trying to kill it. That could be, only that kind of a tidal wave of assault would create a rate cut, in my opinion, at this point. But they're pretty dour guys on the credit side. They're really not that optimistic.
So I want to talk about this just a little bit more, just so you guys understand how to read this, because I think it's very valuable. So if you look over here on the lower right, it says now, 1 day, 1 week, 1 month. So that tells you what the odds for a rate hike were 1 day ago, 1 week ago, 1 month ago. So it allows you to see how things change. And for those of you in Twitter Spaces, make sure you go on to the YouTube stream so you can see what I'm showing you. And then you can see 1 week ago, April 28th, the market was pricing in a 65% chance of no change and a 24% chance of a rate hike. And you see how much that has changed to now, which is 95% no change, 5% rate hike. So, there's a lot of very valuable information here. You may want to check it, once a day or something to see the information. And then, as Boris pointed out, December 20.
Kathy, let me ask you a question about this. Historically, how accurate have these been? I'm sure as we get closer to the Fed decision time, these become more accurate. But this far out, a month or so out, how accurate are these?
Well, for what I've seen as far as studies go, is that like all futures contracts, they're very good at predicting the present. Like in other words, they're very good at predicting whatever is the zeitgeist of the moment today. And of course, with KRE being at session lows and everybody is petrified that every regional bank in America is going to be bankrupt. I was going to say, I think part of the reason why the credit guys are so negative is it's very close to home. Like a lot of these guys, banks, the banking desks are all aware of their competitors' balance sheet situation. So it's kind of like, I think they're over assuming the worst here because it's happening so close to home. It's a recency, it's a proximity bias here in the credit market itself. But that it is what it is. Anyways, Kate, go ahead. I'm sorry I interrupted you.
But I think what is important, Corey, is that what this tells us is how traders are positioned and what they're thinking. And I think that's absolutely important because that's important to what is happening now. Because when you have the market still thinking that there is, thinking that the Fed's going to hold interest rates steady in June, then if we get a strong inflation report from the U.S. next week, we have CPI, that could really trigger a much more significant move in the dollar, in gold, in stocks. And I think that this is really important in just understanding what market expectations are. If the market had already, if it was completely different, where it was 90% chance of a quarter point hike and 0% and 1% chance of no change, then if we get a hot CPI number next week, it's going to have less of a reaction. So that's a really important way to think about it.
Next
Great
week,
point. So it kind of tells what everybody's feeling now, and then this is going to be the delta once the actual news comes out.
Yeah, so it's really cool. I think a lot of people don't know that this is completely readily accessible, and it's an interesting way to look at the markets.
Market is looking for core to be 5.5 versus 5.6. I mean, they are looking for a month to month to be 0.4, which is a relatively hefty bump. It'll be interesting to see. Yeah, I mean, I think if you see like 5.6, 5.7 on the core, that's really going to shake up the markets. On the other hand, 5.5 or below, I think anything consensus or maybe even 10 basis points up will be muted. Anything really lower, and we see stocks moon. I mean, if inflation is just more moderated against the really strong labor conditions, you got to think that stocks are going to moon.
So, one of the questions I got earlier today that was really interesting is, why are stocks doing so well today when the number is good and it perhaps signals that the Fed will need to raise interest rates next month? You have bond yields up, you have the dollar up, and you have stocks up, which kind of is a misalignment. And I think part of the answer lies in what we're looking at right now, which is that even though the number was great, the market does not think that it will alter, at least this jobs report, will alter the Fed's plans or their expectations of the Fed's plans to raise interest rates. They think, wow, it's a great jobs number in an environment where the Fed's probably done. And
right.
So that would be good for stocks.
And that's really good. That's really good for stocks for this one very simple reason. People have more money because they have more jobs. The average weekly earnings were at, I think, 4 instead of 3, which is really nice. So they have more money. That means corporations can raise prices, right, under the guise of inflation, and their cost of sourcing stays stationary. If inflation stays stationary, that means the profit margins rise. I mean, CP&G, all the P&G, all the CPC companies are just eating at the trowel right now because they can raise prices, 50 cents, 25 cents for Kellogg's and everything else under the guise of inflation, and they know people will pay it because they have a little bit more in their paycheck. And they're it becomes all P&L to them because their costs are essentially stationary. Pretty much all input costs, I think, have really either stopped or actually starting to decrease. So you have like the best of both worlds. You have a margin expansion story here, if that's indeed what's happening. That's why stocks, really mooning.
Yeah. So someone's asking, can you share the URL of the CME Group website? Just Google CME FedWatch tool. And then you'll just click on the link and get that link.
LMGFY. Let me Google it for you, as one of our friends used to always say. Whenever somebody asks me, let me Google it for you. It's the same thing. That's usually whenever you're looking for a resource, it's the easiest thing to Google it. Yeah. Also, by the way, Ask GPT. It's an awesome kind of a search tool. You can say, please give me the URL for the CME Fed Funds tool, and it will give you the URL. It's really great at understanding English. So go ahead, Corey.
Oh, yeah. Very powerful.
Yeah.
Yeah. So, many people are wondering.
So, Kathy, let me ask you this. How does this relate?
Go ahead.
Sorry, Corey.
I think you froze.
Corey, did you freeze? What happened to Corey?
Corey, I think I'm back. I think I'm back, guys. Sorry about that.
You're back. Okay.
You there? Okay.
Yeah, we hear you.
Kathy, how does this relate to what's also known as the Fed dot plot? Is that the same tool, or is this just a different way of looking at the same thing?
Oh, it's totally different. The Fed dot plot is what Federal Reserve presidents think, or where Federal Reserve presidents thinks interest rates will be in X amount of time. This is what the market thinks. So the dot plot doesn't change. First of all, the dot plot is only released quarterly. And this is like real time every single day or minute. And that's, what the academics believe where interest rates will be. This is where the market believes what interest rates will be and what position, and then this directly affects market positioning. So it's a really good question, and they are completely different.
Right.
Got it. Thank you for the clarification.
This is where the money is bet. People bet money on Fed funds futures, whereas a dot plot is just simply the Fed governors and presidents' estimate of where they think the rates will be. It's kind of a consensus view,
And also, with the dot plot, they have to. There's a lot more to take into consideration. They have to consider the reputational risk too. When they make a decision. Actually, no, the dot plot's anonymous, but still, in general, the
organization itself, absolutely.
Yeah, I mean, you don't see a lot of variance on a dot plot. There's a lot of consensus building on that thing. There will occasionally be certain outliers, as there are on the policy board, that are either uber hawkish or uber dovish. There used to be, I think, even more. Now there's a little bit more consensus on the board. I mean, Powell is a very, very consensus-driven chairman, actually. I would say more so than just about anybody I can remember in the near past. Not that, they were controversial. I mean, Greenspan probably was the most dictatorial, right? Bernanke was the most academic and congenial. Yellen was great, although a lot of people, give Yellen grief. I thought she handled the Fed chairmanship really well, given what the hand that she was dealt. But Powell comes from that sort of corporate consensus building, and his personality is generally, I think, non-confrontational. So he always tries to build a lot more consensus on the board. Yeah, it's interesting to see the culture change on the Fed like that.
Sure. Yeah.
So,
all right. So if you gotta jump into. I'm sorry, Kathy. Go ahead.
Some people asking about gold. So I think that's always very interesting. I think I want to share my gold chart. And those of you that are on Twitter Spaces, make sure that you log into the YouTube link. So I'm going to share my gold chart, and let's talk about it. Okay, so what am I on? Let's look at the daily chart. No, let's actually look at. We'll start with my zip indicator. All right. So right now, gold is in the sell zone, and we did have a little bit of a buy signal over here. But I think in a prior session, we talked about how when I trade, moving average clearance is very, very important to me. So this is the 1 hour chart of gold. And if we bring back in, if I hide my zip and I bring back in my moving averages, you will see at this point, we were just hovering around the moving average, and there's no moving average clearance to the upside because there was, we've got the 20 SMA right over there. So it did not look like it was a strong pattern to take. But now what you're seeing is gold move into the, let me just bring back up the indicator, the sell zone territory. And it's sold off quite a bit. Obviously it's bouncing a bit, but I think it's moved into a new regime because this is the first time we've seen it in the sell zone since the beginning of the week. So I think, the tides are shifting. It's obviously shifting because the US dollar is rallying and because stocks are outperforming. So that is negative for gold. And if we look at the daily chart of gold, and let's remove this, bring back my other chart, you can see that we had not huge, but decent reversal candle on May 4th. Now we are sitting right at support. So 2000 is, we always often talks about the significance of round numbers. So it shouldn't have been any surprise that when gold kind of collapsed this morning, it made a run for the round number at 2000. If and when we close below 2000, then I think that would open up a door for a much more significant move down to 1950 and maybe even 1940. But I think that the new highs we saw in gold is something that we won't be revisiting in the near term. What do you think, Boris?
I think this is the most what's the word, even-handed chart you can possibly imagine. Like you literally I can read it bullishly, I can read it bearishly. So if I want to read this bullishly, it's making higher lows, higher highs, still holding bid on the daily chart. This is just a retrace in what is essentially a slow grind higher. But honestly, if I was going to be a bull, I want to, as I said to you, I want to see 2100. I want to see shockingly, meaningfully, all-time highs printed, so that everybody's, all the shorts scamper for cover, and we have a meaningful bid. On the bearish side, it's clearly looking like distributive, right? Also, the double top distributive starts breaking down below this 1960. It really cements that double top area. That moving average, that's the blue one around 1950, also looks very suspect. And I think it's all a function of these two opposite forces. The fact that the U.S. economy remains relatively robust and rates remain high, which is toxicity for gold, versus the idea that we have Armageddon on the financial system and everybody's going to run to hard money, which is one of the main reasons why this thing was rallying. I'm actually curious. I was going to ask you, Kay, if you can pull up the Bitcoin chart, because
absolutely.
How digital gold is doing, and sort of I want in a race between the two. Both have been bid. But in a race between the two, Bitcoin looking just a tiny bit, I think, a little bit better. Although also Bitcoin, same idea. I think in all of these situations, this is really my lessons from the school of hard knocks. It's a lot easier to let the market forecast it for you than you trying to forecast it yourself. Like, let me give you an example. Right now, we're all interpreting this chart. And we're like, oh, could it be bullish? Could it be bearish? Maybe I should go long. You could go long here, and it's a punt. You really don't know if this is basically a triangle, and if it's going to, resolve to the downside, or it's a breakout to the upside. Your gain here is 1,000 Bitcoin points, which is nothing. Maybe 1,500 points. In other words, getting in early here. On the other hand, Bitcoin clears 30,000. Gold clears 2,100. That's very definitive. It could also be wrong, but at least at that point, there's such a meaningful price signal from the market that the chances are higher than lower than we're going to go up. So when I look at these charts, as a long-term trader, not as somebody who's scalping, the 1 minute chart like I do on my regular day job, I don't want to commit until I see the market commit. Then I'm happy to commit. In other words, I guess in a strong trend, you want to chase highs. In a strong trend, you want to chase lows. You don't want to be the first guy across the line. You want to let the other, guys run in front of you and then run behind them, because that's how winning is done.
For a new trader or somebody who's just starting out, that's a hard thing to do. With the FOMO and people have fear of missing out, they want to get in. How do you develop that skill? And once you have it, how do you strengthen it?
As I said, it's the school of hard knocks skill. I've seen. The point is that you want to be smarter than the market, and that's always a sucker strategy. Like right now, it looks really, really tempting to get long here because it's so inviting. It's it's at support. It looks really great. If you're right, it's going to break out, and you're going to feel so good. And you're going to remember that one time where you were right, and you're just going to suppress the 9 times when it was a false breakout, or it went up like 30, 40 points, or 200-300 points in Bitcoin, and then completely reversed and stopped you out. I'm a big believer that especially when you're trading price-based instruments, like Bitcoin and gold have no value. Okay, I don't get it. You can all come at me on Twitter. They have zero actual value. Their only value is in their price. And when you're trading price-based instruments, you should really let price guide your trading strategy. It's not like you're buying a company with a whole bunch of assets behind it that you can sit on for 5 years, like Warren Buffett does, and monetize it that way, because there's no assets here. So if you're trading price-based strategies, you want the price to prove to you that it's going up or it's going down before committing to it.
And just for the listeners, where do you like Bitcoin? Where are you long Bitcoin?
Me, I like it above 30,000. I want to see, if it closes above 30,000, or like a little bit higher. It's hard for me to look at this chart, but sort of again, above all these highs. And with gold, obviously, I want it above 2,100 because that's a historical high. Once you clear historical highs, then it's off to the races. Then the market is sending you a signal that something material has changed in the makeup of that particular instrument that deserves your attention.
Guys, chime in the comments. I'd love to hear some comments from the viewers on those perspectives. I know you're going to get a lot of heat for those gold comments, Boris.
I wanted to answer your question of how do you avoid FOMO? And I think the answer is very simple. Follow your rules, follow your rules, follow your rules. 99% of your mistakes will 99% of your mistakes are generally made by breaking your rules. So stop doing it. And it's the only way that you can try to remove your emotions out of your trading is to focus on the strategy, focus on your system, and follow your rules.
Great point. Great point. It's something I beat that drum for many years. So that's the most critical thing, particularly starting out. We talked earlier about that these trades, and people spend a lot of time in front of the charts getting familiar with this trade and marking it up, and they fall in love with it, and they kind of just hope for the best, where it might be against the rules and against their best interest. But having a strong set of rules is going to be paramount.
Yeah, the way to think about it is, when you start thinking about probabilities, the fear of losing starts to disappear. And if you start trusting your trading system, then the fear of missing out starts to disappear. And so the fear of failure disappears when you start thinking in long term, and not just what happens yesterday or today. So, that's why everything depends upon, trusting and following your rules and trusting your trading strategy.
I'll add one other thing to this that I think is really interesting. So if you guys go on my Twitter today, I posted there's this investor whose last name matches mine, which is why I find him. His name is Walter Schloss. Never heard of the guy. Apparently one of the greatest investors ever. He was friends with Warren Buffett, worked with Graham. Had literally, when you're looking at, I came across his name because I was looking at all these guys who were supposedly great investors, and all of their track records are 10 years, 15 years. That's nothing. This guy had a 50-year track record of beating the S&P, which is astounding. And I forgot my point. So the one thing that he had, which was really interesting, was great belief in diversification. He never bet big on any one position. So he was able to just stay patiently with, he was a contrarian. He used to be a big value investor, would just buy stuff, hold it for a long, long time. But because he bought it in such relatively non-injurious quality, it allowed him to have the patience to stay in the trade. And I think, obviously we don't trade that way when we're trading on a 1-minute chart, but the principle of trading small, so that even if you have 4, 5, 6 consecutive losers, it doesn't. The reason why I think people leave their discipline is twofold. The trades don't work, and the trades really, really hurt their account. And that's the second part of it that everybody underestimates. It's the hurt of the account that really puts you on tilt, that puts you into that, I got to get my money back today because I can't believe I lost 25% of my account today. If you're ever in a situation where you lost 25% account in one day, you are trading way too large. You basically have to say, if everything goes to zero, I want to lose 2.5%. Now, the flip side of that is it means you got to trade tiny, and you can't make $1 million tomorrow. But if you want to stay and be alive, not just for tomorrow, but for the rest of your life in the markets, that's how you got to trade. So I think that's sort of the underappreciated aspect of it. Size is always underappreciated as an element in both destroying your confidence and just giving you the fortitude to stay with your trading plan. Anything to add to that, Kay?
Right. And that's one of the unbuilt for you. You have to follow those guide rails. You have to kind of follow the rules and lot limits. And so somebody without a trading plan, or somebody who's unfamiliar with the trading plan, they kind of come in and they're forced to have one. So it builds good habits from.
Yeah, absolutely. Great habits to have. And, for those, we're still getting a lot of questions about, the outlook for gold. I think it ultimately depends upon next week's inflation report. I mean, that's going to determine how, just like NFPs kind of, caused the big vol in gold today. I think that when we get, the inflation report next week, that's going to determine where it's headed. So it's probably going to end up grinding until then, because that's kind of the next major catalyst for equities, currencies, commodities, and Bitcoin to some degree. Yeah.
I'm actually, are you impressed at how robust, resilient Bitcoin has been? I'm actually really impressed with the fact, because, I'm the biggest crypto skeptic in the world, but the fact that it's held bid, that it's at 30, that it didn't really, after it had a huge sell down, didn't collapse below 10,000 and kind of, went off into the what is it, the beanie baby land, is really really impressive. I think it may actually be an endurable digital asset if it just stays around like this.
I'm not surprised at all. I mean, there's you and I, we all live, the three of us live in the U.S., but abroad, there's so many countries, so many people who primarily, do their, even some of the vendors we have want to do their contracts and be paid in crypto because of the volatility and the uncertainty in their local currencies, and other regulations and things like that. So they want to be.
We do as well. We do as well. We pay out in crypto. We take crypto as payment, so it's becoming more and more mainstream.
And because of that, I'm not surprised. I was a buyer when it dipped, because I think it's here to stay. Now, Corey, how like, could you say like a percentage of people that pay in crypto? I'm sure it's still a fraction right now.
Oh,
Like,
it's definitely a fraction. However, there are some countries, like you said, where their currency is a little more volatile, and they prefer to receive in crypto. So, I'd say Central Asia is very big. A lot of the African countries, large. Even in the U.S., it's gaining popularity. A lot of U.S. people want payments in crypto as well.
I think it's because the crypto obviously is solving two issues. One is, like you said, the currency fluctuation, but I think that's the minor issue. The bigger issue is that it affects basically an end around the banking system. In the U.S., we have, until 2 weeks ago, a really sound banking system. No, I'm just kidding. We still have a sound banking system, but we have rule of law, we have contracts, we have banking system, very well financed. All sorts. Like, if you're a regular human being, there is no doubt that if your money in the bank is going to be there tomorrow, even if the bank themselves goes out, you're fully insured, so on and so forth. Nobody in the emerging markets has that kind of confidence, and also it's just incredibly, from what I understand, it's incredibly tedious to do payment settlements in a lot of these countries where there's enormous amount of bureaucracy and huge amount of VIG. The banks take huge amount of VIG on the transactional side, whereas on Bitcoin, obviously, it's much easier, much smoother. So the other thing that I find very interesting about Bitcoin is that Bitcoin is basically essentially a settlement into the U.S. dollar. Once people get paid in Bitcoin, then they go buy Tether. They go buy dollars with Tether. So it's just it's an end around to US dollar as the base currency.
I mean, basically, they convert it immediately to stable coins. So
is
why. So why are you surprised that it is not back at 30,000?
Yeah, I mean, you're right.
Because 10,000, it was dead.
No, it's because you're right. Because I had a very ethnocentric view, because I live in a first world nation with lots of I don't need Bitcoin. The point is, I guess that's the thing. As an American, you don't need Bitcoin, but the rest of the world,
it was solving a problem you didn't have.
Actually solving, it was a problem I didn't have. But it is solving a problem that lots of people across the world have, that don't have the access to our infrastructure and our financial system. So that's
Kathy, I think you just turned him. I think he's a Bitcoin guy now.
Well, no, I've been coming around to that point of view that, and the price. I always find it's interesting. I think when you have a thesis, and that thesis is proven, and the price is proving your thesis wrong, instead of the natural instinct for us is to always say, no, the price is wrong. The market is wrong. They're a bunch of idiots. It's always much more intelligent to check your own thesis and see, what am I missing? Because sometimes you could be right. Sometimes, you're short a stock and there's a squeeze on the stock because somebody's manipulating it. That's fine. But a lot of times, especially on the macro side, because I see this with macro analysts all the time, they'll have a thesis. They'll be wrong. They'll be wrong 3 months forward. They'll be wrong 6 months forward. They'll be wrong 12 months forward. And they still stay on that same thesis instead of saying, where am I wrong? Like, it's much more intelligent as an investor, as a trader. I don't have, I'm not an analyst. Kathy always says, we're analysts who trade. Therefore, we don't have any ego. If we have a thesis that's wrong, if the market is telling us, we try to change our facts or try to understand our understanding. Like, recession thesis is a perfect example. For the last 2 years, all the big macro guys have been, we're going into recession in 2 months. Well, okay, 2 months are gone. No, we haven't. No, it's coming in another 2 months. No, trust me, it's coming another 2 months. Like, at what point are you going to say I'm an idiot? I clearly misunderestimated the resilience of the U.S. economy, the strength of the Main Street economic production, and that I think is also very much a function of just like how people have a political blindness. So they have, blindness economically. They just stick to one point of view, even though the facts are completely dictating the exact opposite. That's why you have this huge divergence between University of Michigan sentiment survey, which means nothing. It's basically people's opinions versus how people are actually doing where they're spending money. Go to cruises, go to airports, go to vacations. People are burning.
We were just in Vegas. It was packed.
Right. It was packed. Right. We're just in Vegas. Just packed. Right. So that's what I always find ironic, about how this is where trading, I think, is really, really great tool for much greater value than just trading. If you can absorb its lessons, you become a lot more humble in your opinions, and you actually open yourself up to much better decision-making processes, regardless of whether you're trading or not, just in life in general. Kay, what do you got up there?
Well, I just want to point out, earlier we talked about moving average clearance, and it's a very easy, simple way to look at the markets because we're looking at the Bitcoin chart. And you can see when we finally cleared above all of the major moving averages, and we hadn't been there in a very long time, in months, we hadn't been above the 200 SMA in Bitcoin. That basically triggered a really nice uptrend. And then when we did it again, this one's less powerful because we didn't have as much of a dip. But when we got in above all the major moving averages, you also had a second, smaller move in Bitcoin. And, the third time we're above all the major moving averages, this becomes the much more explosive move. So, just as a general guide, typically, when we do move above all major moving averages, you got to think bullish, not bearish, and, ride that move for as much as it takes. And that's, an easy way to put yourself in the right market regime and the right side of the markets. Because with any instrument, Bitcoin, gold, currencies, the best trades are the ones that are aligned with, the overall trend and the overall sentiment that the market has for this instrument at the time.
Yeah, that's a really good point. And really, it is a really easy way to see. I mean, third time is the charm here on Bitcoin. It's a really interesting way of looking at it. Absolutely. But can you put gold on that? Let's just see what's gold doing.
Okay. Hold on. This is gold, and it's similar.
Doesn't look bad, right?
Look at this. I mean, this is not obviously nothing is foolproof, but look at this. We're above all the major moving averages, and actually, this says that. And sometimes it's a big move, sometimes it's a small move.
But it's still holding good. I mean, if that's what I'm saying. If you're
over here, this is the short trade over here, and the first move is always the best one. At some point, you get tired, and it kind of exhausts itself, but you still get a little bit of a move here. Very simple trading strategy that can still be pretty powerful.
Yeah, I'm just interested. Like right now, it's still looking. I mean, it's still looking more bullish than bearish. If you go to the end of the chart here, it's basically holding bid. Like it's only if only gold kind of breaks to that below that purple level, can you say it's kind of done? If that's what I'm saying. If it turns back up to 2100, forget if you don't use indicators, just price flow. It will confirm the same thing. It's cleared everything. It's ready to run.
Right. So we had a question about oil. Can we talk about oil? Why don't you love talking about oil? So I'll leave that to you, Boris.
Okay. So, oil is obviously crushed. And again, so I am an oil bull at this point. I thought oil in that 65 to 70 is a value proposition. And it still is actually, if you look at the chart, because what you see here is absolutely oil is definitely crushed. Market is still, not feeling any kind of economic. Basically, market is pricing in economic contraction. That's why oil is crushed. It's great for us. It's great for inflation. I'd love nothing more than for oil to stay at these levels, and it would be ideal if we just sort of stay in this range. But it's not a place where I would want to short because, as you said here, look at this. If you look at just Kathy's chart, we're getting exhausted at the bottom, right? There is a natural support here in the 65 level. And then if you just simply look at the fact that the global economy continues to grow, even at a modest pace, yes, China has not been growing as much as people anticipated, but still not terrible. It's hard for me to be a bear here. I may not be a bull, or I may be just a value. I may be a bottom picker here with a trade below the lows. Like if I'm below the lows here, clearly I'm wrong, and clearly we have some kind of a recessionary impulse. But generally, my view here is I'd rather be a buyer than a seller, just on a fundamental point of view, and from a technical point of view, it's definitely a turn trade, but I'm buying the bottom, so at least I know where my risk is defined.
Yeah, I think he's right, and also it's the moving averages are important. It's no surprise that the 200 SMA was a very important one. It's where oil found support back in March, and it's kind of around where it found support now. So it really needs, if you want to be an oil bear, you need like a firm close below this. Otherwise, we could see a bit more of a recovery. And plus, this looks super bullish.
That is a bullish. Is that a daily?
That's a daily, yeah.
Yeah, it's a daily. So it's pretty nice doge. Yeah. Yeah, so that's sort of my view. I mean, I'm cautiously bullish. That's how you would want to say it, with a very defined risk if I'm wrong.
Are
So
you liking enough to take this trade?
Me, yeah, hell yeah. It's a relatively, I mean, again, in size, you gotta size yourself. Like I think it's a 1% risk trade. In other words, I'd risk 1% of my capital for this trade because I think it's pretty good at this point. If you're sort of a longer term, I mean, I like oil across the board. I like the oil majors. I like Exxon. We were doing a show on CNBC last week, and my view is that one of the most underlooked stocks was Exxon. Exxon has just printed the best numbers they've ever had. The stock is down because, again, oil is down. But if you basically believe that oil is going to stay here, worst case scenario, oil stays here for the next year and a half, all the majors still printing money. So I was going to say, so the other trade you can do, which is a defined risk trade, is just simply take a long term, take a leap, an XLE, take a long term option contract and just kind of let time work for you if you think we're going to recover. So that's another way of trading it with a limit defined risk, but expanding your time horizon.
Right.
So taking a look at the calendar, I think we just talked a little bit about, what's ahead. So we already talked about how the most important event is going to be the U.S. inflation report, the U.S. CPI report that we have on Wednesday. We also have some Chinese data. Chinese data has been terrible. And it shows that even though they reopened, there wasn't that resurgence or as much of a resurgence in the economy that everyone anticipated. So the trade data is expected, the inflation data is expected, both of which could be softer. And then we've got the Bank of England rate decision. That's the only rate decision that we have next week. And you can see just from the quotes here, euro pound towards the bottom. Here, let me see if I can change my chart. Is falling. Just get rid of this. Is falling. It's falling because the Bank of England is widely expected to raise interest rates. So we got terrible Eurozone data this morning. German factory orders, Eurozone retail sales, all of it got shellacked. And then you have better UK data. The PMIs are revised higher, and the Bank of England. It's always about what's happening next. So the next one at bat is the Bank of England. So the market gets amnesia about what happened this week and how the ECB raised and they were hawkish. So now they're thinking about the BOE. That's in focus. BOE is expected to hike. Obviously, if they don't, this would be disaster for pound. But traders are buying pounds going into BOE. And we're getting this, if we get a close below the 200 SMA, it's a pretty big deal. We also have UK GDP numbers on Friday. But that's pretty much it. US CPI, Bank of England, Chinese data, UK GDP. That's, it's not like this past week where we had a laundry list. And that we have just a few, but important things to focus on next week.
Yeah, absolutely. Speaking of which, should we discuss a little bit about how I traded non-farm payrolls today? We had a very, very good session in BK. Those of you guys who are in Surge,
yeah, please, are
not coming into live trade with me, you're leaving money on the table. We hit 5 out of 5 trades today, really, really nicely. But I'll show you a very, very simple setup. We actually traded dollar yen today, and let me grab my screen here. You mind if I grab the screen? Yeah.
No, grab the screen.
Okay.
Just seeing if we have any questions. If you have questions, you can post it on YouTube. We'll be more. And if you want to look at the screen, I posted the YouTube link onto the Twitter space. So make sure you click on that so you can look at Boris's screen. All
right. So yes, and yes, my screen is all elongated. I have Kay always gives me grief for this because
just zoom in.
I'm zooming in. No, I'm zooming in. But what I'm basically I have 2 what's called double monitors. So these are if you stack 2 monitors one on top of each other and made into one monitor. So that's I have 2 of these kind of monitors because I really like the length of it. It's actually really cool to read stuff on it too. But when you're showing it, it's a little bit skewed. But what I wanted to show you is this. This is dollar yen, and the big candle is obviously non-farm payrolls. This is the 1-minute chart, right? So let me just kind of zoom out just a little bit to show you. So this is our proprietary bounce indicator. It looks a little similar like Kathy's in the sense that we have sentiment changes, with the red and green. But I look at the price action, kind of like the way I look at a football field or a soccer field with 2 ends of the goal. So let me just kind of go to auto fit state of the screen. If you look at the field of play today, the red line is the low of the day, the green line is the high of the day, the black line is the middle, and these are the quarter marks, right? These are like the touchdown and the end zone. This is, if you were playing soccer, this is like, the goalie area. So the way we trade is super simple, but it's just so brutally effective in these news events. First, we need a news event, obviously, right? So we have non-farm payrolls. Second, we would love to have reaction. Like you can't be like, oh, it's in consensus. There's no price movement. If there's no price movement, we don't really get interested. But if there's price movement, we have the setup is really, really great. I'm going to give you the whole recipe, and you guys can try it out if you want to. So the recipe is the following. We always wait for the first minute to complete. We got to have the candle weights, right? So once we complete, if we're above the midpoint, we're buyers. That's just like, if we're above the midpoint, we're always buyers. We don't care what the data is. We only care what the price is. So if the price was positive against the data, we're buyers above the midpoint. If the price was negative, below the midpoint, we're sellers. Now, we're going to get long at this 135.86. It was actually, we got along at like 83, I think, whatever it was, right? And I think, and this is very, very important. So we get along over here. We have a 10-point target, 10-point stop. Before you can blink an eye, and by the way, I will say this, that none of this can be done by hand. We have a robot that all of the strategy is pre-programmed to the robot. It executes for it because it's got to be fast. It's got to be fast. You can't, like in these news reactions, you got to be super fast. So the robot gets in, and immediately gets stopped out. We're stopped out, no problem. It's we're just beginning our trade. Where everybody quits because they made the first trade and they quit. This is where we start the trade. So we get stopped out, no big deal. It's a normal retrace. We're just waiting now. Next. Remember, we're still holding bid. We're still well above the midpoint. The next green candle is this one right over here. I'm going to mark it off. Boom. We go back in. The difference between us and everybody else is that we don't quit on our trades. We go right back in. Right here, I'll make it black. Go back on this candle, 81. That's it. Actually, we got printed 82. I remember this. We got printed 82. All we're looking for is 92. 1, 2, 3, boom. We get hit. It took us 5 minutes. We're done. If you do one lot trade, like we basically bet $100,000 account, $100. That's it. We're not taking huge wild risks, but it's super easy to have completed this trade within 5 minutes, and we were done. Boom, boom, boom. Thank you. And did the same thing yesterday on ECB. I'll show you if you want to see the ECB trade on euro. Same concept, but it was the other way around. I mean, we could have traded the euro too, but I like to trade dollar yen on US data, and I like to trade obviously euro on the European data. So let's go to ECB. Let me just pull this out. And I'll go to replay action so you guys can actually see how the price action was going on. So this is it right here. I was talking to the guys. I was marking it. It's marked. I mean, I'm happy to show you the replay action so you can actually see the highs and the lows on my indicator as they were at the time. So you can see, okay, so euro a little bit above the midpoint, right? Just before they come out, boom. They announce, this is the announcement, right? So the announcement is here. We get short at around in this candle over here, 49. Boom, I get stopped out again. Happens. It's part of this is why you have a 10-point stop. If I'm wrong, 10-point stop. I'm not crying. We come back right in. Second trade over here. Again, we don't quit. We come in at 49, and it took about 10 minutes. Boom, 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 boom. Thank you very much. 10 points. So hopefully you get an idea of the recipe. There's a couple of components here. You need lots of volatility. You need very, very controlled risk and reward parameters, which, by the way, so this guy, Walter Schloss, I was talking about to you, the guy who is one of the greatest investors in the world, right? Compounded at 20% for 50 years, which is really astounding.
Wow.
Contrast to Warren Buffett, the guy sells 50% up. So he buys the stock If it goes 50% up, he sells most of it. He locks in his profits. That was super interesting to me. That's how the guy made all his money. He would just buy cheap, sell it out, buy cheap, sell it out, buy cheap, sell it out. That's the name of the game. We try to do the same thing. In other words, not in the sense that we buy cheap, sell it out, but we never get greedy with our profits. Just boom, boom. This is a very well-defined strategy if you stick to the rules, as Kathy was talking about. Stick to your rules. Boom. We just take our 10 pips, $100, goodbye, thank you. You do 4 or 5 of those a week, you're doing very, very well. And this stuff works great. I mean, we love it. It obviously requires a robot, which we provide for you if you come join us at BK and become a VIP. You can watch us. You could try to mimic it yourself on I think on currencies, most of the time you could probably do it manually because it's not that fast. On equities, it's super fast. But regardless, it's just a fun, very, very effective, productive strategy. I just wanted to share with you guys today.
Thank you. And just so you guys know, whoever's watching or listening, anybody who auditions with Surge will get a 30-day free trial to BK Trading. So you have access to all of this mentorship, all of these indicators. So you can go ahead and try them out for yourself. And then of course, sign up with BK Trading for the long term.
Exactly.
All right. Sounds good. I think we're good with the questions. Do you want to wrap it up?
Well, if you would just go over the what we're looking at next week for news one more time, so they could jot that down.
Okay, so there's 4 main, general events. Number 1, the most important, U.S. CPI. You got PPI, but PPI doesn't matter because it comes after CPI. And then you have the Bank of England's rate decision, where it's a close call, but the market's thinking rate hike. You've got Chinese trade and inflation data. That's fairly important, especially since data has been so terrible. And then you have UK GDP, which will be a little less market moving because it comes after the rate decision, but it's still a number to watch. But that's it. It's not like
Perfect.
This week where we had laundry list.
Yeah, we sure did. Awesome. Well, again, thank you guys so much for joining, and we will see you Monday, and we'll touch base. Hope you guys have a great weekend. And anybody who's tuning in, thank you for joining us as well.